What's going on, guys? It's Danny Sully here. In this video, I'm going to explain to you trading options and how it relates to throwing the Hail Mary. If you're watching this, it's because you don't understand trading options. And that's okay, because a year ago when I started, I had no idea either. I talked to a lot of friends and family, and I did a lot of research on the topic, and after a while it started to click to me. So if you're watching this video and this helps you, click that like button below. Now, options in my most simplest words is betting on a stock to go up or down by a certain date. Now, this date is called the expiration date. And if the option goes through this expiration date, it is then exercised. And this means that the option will either give you a return, which could be a lot of money, or it will become worthless. Now, it's important to understand that you don't have to exercise an option completely at the end of the expiration date. Now, you can sell this before that date, and you'll actually be able to make a higher return if you do this right. So if you purchase it on the one day and the next day it goes up a lot, let's say 5%, you could sell it right then. You don't have to wait. So there are 4 topics and options. You can buy a call, you can sell a call, you can buy a put, and you can sell a put. Now, the first one I'm going to discuss is buying a call. This is betting that the stock is going to go above the break-even price. This break-even price is the share price or the stock price that you think the stock is going to pass, plus the premium that you paid for the option. Buying a call and put are the most popular types of options, and I think that's because it's a lot more riskier and people doing options want to see the high risk reward, whereas selling a call and put is a little bit more confusing and not as popular, but is in fact a little bit safer. Buying options does not require a lot of money, and that's why new investors like this approach, because they are willing to take on the risk. Whereas selling options, you have to have a lot of money because you're going to end up buying 100 shares of that specific company. Now, if you're serious about options trading, what I recommend, what I personally do, is going to Options Profit Calculator online. Once you're on the website, you can see that it says basic. You're going to hit the long call. And once you're on the long call of buying, you're going to type in the ticker symbol. So let's say Apple, AAPL, get price, and it's going to give you the current price of what it is currently. Now, what you're going to go is go below the option, and since you're buying it, not writing it is shorting it. Shorting it is also a reference for putting it. So what we're going to do next is we're going to select option. Then we're going to hit the date October 30th, and we're going to scroll down to the share price, and we're going to pick the strike price to be 120, and then that means the break-even price is going to be 122.55. So we're going to click that, and our total cost is going to be $255 because you times that by 100, the 100 contracts in the option. For those that are confused on what a contract is, it's an agreement between two people where they're either going to buy it or sell it, and each contract has 100 shares in it. As you see from the chart below, when it's 122.5 or lower, it's a negative answer, which means that you're losing money no matter what. And when it's below that strike price of 120, you're losing everything no matter what. But if it's above 122.55, the strike price that we just discussed, then it's going to be higher and higher the more that it goes above that price. What I do before every options purchase is I look at this and I see, well, what are the odds of it getting to 124? And if that is high, or if I believe the company can do that, then look at that return and say I'm satisfied with that or not. And if I don't, what are the odds that it's going to be below and that I'm going to lose all of my money? Now, when you're buying a call or a put, you're getting at a partial share of that contract. And when you're selling a call or a put, the reason you have to pay so much to the end is because you're actually purchasing all 100 shares of the company. Now, let me show you an example of writing it, short selling it, or putting it. So we'll go up to options and we're going to hit write. When selling a call or a put, you have to realize that when you're buying this, you're buying all 100 shares no matter what. The biggest difference with buying and selling calls and puts is that when you're buying, you're getting a partial share of the 100 amount of the contract. But when you're selling, you're buying all 100 shares at the end, and it just depends if you're going to get more or less at a cheaper discounted rate. Now let's look at an example of writing for a call, which is basically short selling a call. So we're going to do the exact same thing we did before with $255 premium at a $120 strike price of Apple. As you see in this example, it's the exact opposite, where the higher the strike price goes, the more that you're going to lose. If the share price of Apple goes above the $122.55, then you're going to lose no matter what. But if the strike price stays below the 120, you're going to get the $255 no matter what added to the 100 shares when you have to buy it. As you see what happens when I click one of the numbers in the chart, it actually gives in the top right a description of what is going on and how that price is coming upon. So for this example, when I bought it on October 30th for a $120 strike call, the reason that it subtracts 600 is because it's $6 of a difference between the strike price, because that's saying that this is from 126. The entry cost was the premium times the 100 that you had to pay for that. So let's look at this chart really quick. On the left, The calls are decreasing in price because it goes from a lower number to a higher number of the share price. Now when the share price is lower, that means it's safer for you to buy that option, which is why the price is higher. You have to pay more to have a safer option. But for the puts on the right, it's the exact opposite. When the stock price rises, the price of the put is actually going to be higher because this is a safer bet. You're betting that the stock is going to be a premium of, say, 128, and it's actually going to be a lot more likely to have a stock below 128 instead of a stock below 118 or something that's lower than that. This is why when you are at a lower share price, the price for a put is cheaper. It's more risky. But if you want a safer pick, you're going to end up picking one that's not 10 cents for an option, because this way the option of the stock was going to have to go down below 125.65 instead of 108.87. So in this case, we're going to say that we're going to buy a put at 118. So what this shows is that if it stays above 115, that strike price, then you're not going to get anything because you're betting for it to go down. But if it does go below, you can see it has the same effects as calls, where if you're buying a call and it goes up, you'll get more. This way, if you're buying a put and it goes down, the further more it goes down, the more you'll receive. The only time it's reasonable to be buying puts is when a company is going out of debt or bankrupt or something really bad just happened to them, or you know something worse is going to be coming. Now let's look into the last aspect of options, selling a put. Now we're going to say the exact same strike price and premium as we did for buying a put. And we're going to hit calculate. And as you see, it is the exact same opposite. Now the relation between this and buying a put is sort of the same as buying a call and selling a call, except this is the exact opposite way. So for this example, to make money in the option, the stock has to go up. If the stock price goes down, you're actually going to lose money. So let's look here and say that the price goes down to 109. We can click on that and actually see the details if it happened at the end of the expiration date. And that would be a price of $6 that it's going to be below our strike price of 115. Now this is going to be minus 600, and the credit that we got at the beginning of the premium was $3 times the 100 shares of 300. So we're actually going to lose $300 from this. But you have to remember that we're going to be buying all 100 shares. So if you're putting in $10,000, you're only going to be doing the 9,700. That's why the percentage increase and decrease is nothing compared to options of buying. Now I'm going to give you 3 tips of advice for options. Excuse my handwriting, but so for the first one, you have to understand the market. If you understand why trends occur, which is what options are, is basing everything off trends, and say Tesla's battery day, COVID-19, government stimulus packages. If you understand why these things occur or how some things could affect the company, or if Apple goes down 5%, the fundamentals are still there. They could definitely go back up 5% in the next 2 weeks or month. Then you have to understand what you're getting into before you go into an option. Second, don't go in right away. If you don't know what you're doing, you could end up losing all your money. Yeah, you have a chance of making a higher return, but if you don't even know when to sell it, you're screwed. You don't know what to do. Which leads to number 3, is starting small and learning from experience. Now this is what I did, and it helped me a lot. And this is what I personally recommend, because the more you do something and practice in life, the better you get at it. So take options as a chance to learn from it. First, you need to understand the market. Second, don't go in. And third, learn from experience when trading options. Thank you guys for watching. If you have any questions, comment below and I'm going to get back to you. And if you like this, click that like button for me and subscribe for more videos coming up.